Ever notice how your microcap portfolio gets whacked from mid-November to the end of December for no apparent reason? Surprise, surprise. Here's a really good reason. Tax selling. Tax selling involves selling stocks at a loss to reduce the capital gain earned on an investment. Since capital loss is tax deductible, the loss can be used to offset any capital gains to reduce an investor's tax liability. For example, let's assume an investor has a $15,000 capital gain from the sale of ABC stock. He falls in the highest tax bracket and so will have to pay 20% capital gains tax or $3,000 to the government. But let's say he sells XYZ stock for a loss of $7,000. His net capital gain for tax purposes will be $15,000 minus $7,000 equals $8,000, which means that he'll have to pay only $1,600 in capital gains tax. Notice how the realized loss on XYZ reduces the gain on ABC and hence reduces the investor's tax bill. Which stocks are usually sold at a loss to protect the gains in your portfolio? Bingo! Microcaps. Tax selling allows an investor to maintain his or her position while incurring a capital loss. In effect, wash sales are illegal, whereas tax selling is allowable. Tax selling typically involves investments with huge losses, which often means that these sales focus on a relatively small number of securities within the public markets. However, when a large number of sellers execute a sell order at the same time, the price of the securities falls. After the selling season ends, shares that become extremely oversold have an opportunity to bounce back. In addition, the fact that tax selling often occurs in November and December as investors try to realize capital losses for the upcoming income tax season could mean that the most attractive securities for tax selling are investments that are most likely to generate strong gains early in the next year. A good strategy for investors then would be to buy during the tax selling episode and sell after the tax loss has been established. One investor's loss is another investor's gain. Sounds simple. Buy when everyone else is selling and you will have a happy new year. Remember, the Santa rally you see and hear is mostly large cap and mid cap buying by funds and institutions spending their year-end leftover cash, which drives the market higher and helps the year-end numbers look better as they get fully invested. If investors would like to repurchase the shares sold for a loss, they can do so after the 30-day wash sale rule no longer applies. In addition, shares sold for a loss must have been in the investor's possession for more than 30 days. So this year, when your favorite portfolio stock prices start dropping and there's no known bad news, and you did quality diligence, it's probably tax selling. Start scooping up shares smartly by sitting on the bid and let them come in. Do not chase. Be patient. Make your own microcap Santa rally happen. Happy holidays. Also, remember, these same sellers can come back to buy once they've locked in their losses. Thank you, Investopedia, for help in some definitions. I'm Mr. Wall Street, and thank you for listening.